Welcome to Prosperity Magic, where financial secrets turn into life strategies. What if I told you this is the final public play of Warren Buffett's legendary career? The last glimpse into the mind of the Oracle of Omaha before he steps off the global stage forever. Picture this: Bill Gates, Tim Cook, and even Hillary Clinton all seated quietly, heads down, pens in hand. Not as speakers, as students. Listening, learning, absorbing. Because they all knew what you're about to realize. This was not just another shareholders' meeting. This was history in the making. This was Buffett's final public appearance at the annual Berkshire Hathaway shareholders' meeting. But this time, something was different. For once, he wasn't holding back. He laid bare his full investment playbook: when he buys, what he avoids, where he moves next, and more importantly, the assets he believes are doomed to collapse. If you understand what he just revealed, you'll realize this could be the most significant financial repositioning in modern history. Here's the twist. This grand chessboard was set in motion as early as 2003. The clues were all there. What the U.S. government is doing today almost perfectly mirrors what Buffett described 2 decades ago. He saw it coming. He mapped it out. And now he's executing the final move. Last year, as many of you saw in our previous videos, the world's tech elites made their exit. Bill Gates, Mark Zuckerberg, Jensen Huang, they all sold off massive portions of their stock holdings. And they did so just before the global markets took a plunge. Was it luck? Or did they know something the rest of us didn't? But none of them benefited as much as Buffett. Why? Because while others were selling, he was sitting on the highest cash reserve in Berkshire Hathaway history. And not just that. He had already positioned into Japanese yen, a currency that began soaring just as others were falling apart. That's not coincidence. That's strategy. And yet, as markets began to recover, Buffett didn't rush in. You'd expect someone with $330 billion in cash to start scooping up bargains during the crash, right? But that's not what happened. As of December last year, that war chest hadn't shrunk. It had grown. This year, it's reached $350 billion. What does that tell us? Buffett didn't buy the dip. He waited. Why? The answer lies in something he revealed at the meeting. He almost made a $10 billion move recently but backed off. Not because he couldn't, but because it didn't feel right. He said he couldn't find anything reasonably priced enough to justify the buy. And when a man sitting on $350 billion finds it hard to spend even $10 billion, you should ask, what does he see that we don't? He referenced his experience with the acquisition of BNSF, a company whose stock had dropped over 50% 3 times in a short period. Compared to that, he said, this recent crash was nothing. So what does it mean? It means that, despite having the firepower to buy entire institutions like Goldman Sachs or Morgan Stanley, Buffett has chosen not to. And instead of shrinking, his cash position is growing. And then came the jaw-dropping part. When asked how he would hedge against a weakening U.S. dollar, Buffett didn't mince words. He said they wouldn't invest in a currency headed for hell. Even more shockingly, he declared that within 5 years, he intends to spend nearly all of Berkshire's cash reserves, leaving just $50 billion. Think about it. Right now he's hoarding dollars, but he's planning to unload them entirely. Why hoard something today that you think will collapse tomorrow? The only logical answer? This isn't the end. It's the setup. And the real collapse. The financial bloodbath is still ahead. If you assume the crisis has passed, then yes, Buffett's actions may seem contradictory. But if you understand that this market recovery is a facade, then every move he's making becomes terrifyingly rational. And if you don't want to be the victim of this setup, if you want to be among those who rise while others fall, then subscribe to this channel, Prosperity Magic. Because we're not just decoding headlines. We're revealing the playbook. Hit that like button to save this video for later. That way you can revisit it anytime the market starts shaking again. Now here's something that shocked me. Most people walked away from Buffett's speech talking only about how he criticized the U.S. government. But he didn't have to say it directly. Every word he spoke pointed at it. He called tariffs and trade wars a mistake, an act of aggression masquerading as economic strategy. He warned, if 7.5 billion people in the world dislike you and only 300 million Americans cheer, then maybe, just maybe, something is wrong with the playbook. But the deeper insight came from a parable he wrote back in 2003. He described 2 islands, Thrift Island and Squander Island. In the beginning, both islands worked 8 hours a day and lived sustainably. But one day, the people of Thrift Island decided to work 16 hours a day and traded their extra goods with Squander Island. In return, Squander Island simply issued IOUs. Over time, Thrift Island accumulated a mountain of debt from Squander Island, and eventually they cashed it in. They used the IOUs to buy all the land and property on Squander Island. Suddenly, the people of Squander Island were tenants in their own homeland, paying rent to Thrift Island, working 8 hours a day just to pay back debts. Buffett's message? America is Squander Island. While Americans outsourced hard labor to the world and kept borrowing, one day the world would bring back those IOUs. And when they do, they won't just want cash. They'll want assets, land, resources, ownership. Buffett proposed a solution: import certificates. In short, if a U.S. company earns $10 billion through exports, they receive $10 billion worth of import licenses to sell. Those licenses could then be sold to U.S. importers, effectively placing a cap and cost on importing while incentivizing exports. It's brilliant, and nobody implemented it. Now, 20 years later, we're watching his prediction unfold. The dollar is weakening, U.S. debt is mounting, and Buffett is holding fire, waiting for the real opportunity. The final move of a master isn't loud. It's quiet, calculated, and deadly effective. Don't blink. Stay alert. Subscribe to Prosperity Magic. The game is far from over. Let's pick up right where we left off. Warren Buffett's grand design, conceived as early as 2003, is not only unfolding exactly as he predicted, but it's revealing the brutal truth about how America controls the global economy. Now, let's dive deeper into the mechanics of one of Buffett's boldest economic ideas. Imagine this: today, if you want to sell goods into the United States, you can't just do it freely. You would need to buy an import certificate from an American importer. No certificate, no access. And here's the twist. When foreign sellers pay for these certificates, the money flows back into the hands of American exporters. That means more profit for U.S. companies and more tax revenue for the U.S. government. Still confused? Don't worry. Because in reality, this concept mirrors exactly what the U.S. is already doing with tariffs. The American government says tariffs are necessary because the rest of the world is getting rich off of American consumption. The logic is, if this continues, foreign nations will grow wealthy enough to buy out America piece by piece. Hence, tariffs are the defense mechanism. If you want to profit from American consumers, you need to give something back in the form of taxes. That's the government's way. But Buffett's way? He simply called it an import certificate. And if implemented, his system would act like a 100% tax on all foreign goods. His plan was straightforward. America should only import as much as it exports. So while many accuse Buffett of criticizing government tariffs at the shareholders' meeting, the truth is he proposed something even stricter 2 decades ago. Yes, Buffett wanted a 100% global tariff disguised as an import certificate. What the U.S. is doing today? It's just Buffett's 2003 plan in action. So why does he now call tariffs a form of economic warfare? Isn't that contradictory? Actually, no. Because tariffs are seen as punishment, while an import certificate is seen as a transaction, a price of admission. Think of it like this: when you attend a concert and buy a ticket, it feels normal. But if the government charged you a tax just to enjoy music, it would feel oppressive. That's the difference. Buffett doesn't oppose the concept of taxing imports, he just believes in changing the name, the method, and the perception. And now comes the powerful metaphor. Remember the story of Thrift Island and Squander Island? If you believe in that story, then your country is the one being bought by the U.S. But let's look at reality. Can the world actually redeem U.S. debt and buy up America's land and assets? At first glance, it seems possible. But look closer, the truth is the opposite. America owes money, yes. But it doesn't need to earn money to pay it back. It can simply print dollars. And every time there's a financial crisis, American capitalists flood the world with dollars, buying up cheap assets in every corner of the globe. Look at Korea. Major stakes in Samsung, LG, and top banks? Many are owned by Americans. So in the end, Squander Island didn't get colonized, it did the colonizing. If you fall for the Thrift Island myth and work yourself to the bone just to save and one day buy America, you'll likely end up being bought by it instead. This is the grand illusion. The master game of financial elites. So while you're grinding, head down, working long hours, remember to look up once in a while. Because if you think simply saving and avoiding risk will protect your wealth, you may be walking straight into their trap. Inflation sparked by reckless money printing is the silent thief. Even if you don't spend or invest, your money quietly loses value. Suddenly, homes are out of reach. You work endlessly but can't keep up. You rent forever. You survive but never live. And no, ignoring the game doesn't mean the game will ignore you. In this global setup, you have only two roles. Be the exploited worker from Thrift Island, or be the cunning player from Squander Island. But what if you're not a Buffett-level billionaire? What's your edge? It's agility, flexibility. While Buffett needs to plan his moves years ahead, you can move quickly. You can follow the trend once the big players reveal their hand, and exit before the tides shift. That's the secret of small investors. We don't have to lead, we just need to recognize momentum and act decisively. So why did Buffett propose import certificates back in 2003? Because even then, he realized America's old tricks, cutting interest rates and printing money, were losing effectiveness. In the past, when the U.S. economy slowed, the Fed could slash interest rates by 5% and spark a recovery. Lower rates meant cheaper borrowing, more business, higher profits. It worked until it didn't. In 1981, rates dropped from 18% to 13%. In 1991, from 9% to 4%. In 2000, from 6% to 1%. Each crisis required deeper cuts. Then came 2008. The Fed dropped rates all the way to 0%, and it still wasn't enough. It's like a patient becoming immune to medicine. The first 2 pills worked, then 5, then 10. Eventually, no pill worked anymore. So the U.S. moved to the economic four-drip, quantitative easing, printing massive amounts of money and handing it to the financial elite at almost zero interest. To keep investing. That's where we are today. A world flooded with cheap money, but one where real wealth keeps slipping through the fingers of those who work hardest. If this has opened your eyes, don't keep it to yourself. Subscribe to Prosperity Magic, comment your thoughts below, and stay with us. Because in the next video, we'll go even deeper into how you can move from being a pawn on the board to becoming a player. The financial reset is unfolding and knowledge is your only defense. Let's continue unraveling this economic thriller. Back in 2008, the U.S. printed over $3 trillion to keep its economy alive. Then in 2020, when the pandemic hit, another $5 trillion was injected into the system. With every crisis, America reached deeper into its money-printing machine, and now the consequences are catching up. U.S. national debt has ballooned to historic highs. And here's the alarming truth, no one wants to buy U.S. Treasury bonds anymore. Not even with the promise of higher yields. The Fed can raise interest rates. The U.S. can offer attractive returns. But if the world stops lending, printing money becomes the only option left. And when a country funds itself by printing alone, its currency begins the descent into worthlessness. That's why by 2025, with interest rate cuts proving ineffective and money printing reaching its limit, the U.S. had to resort to the strategy Buffett floated back in 2003: tariffs. Think of tariffs as a defibrillator, shocking life back into a failing economic heart. Here's a simpler analogy. America prints the money, while the rest of the world does the dirty work. The world labors, saves, and aspires, believing that one day, hard work will buy them a piece of the American dream. To keep that illusion alive, America must keep spending globally, dispersing dollars around the world. Then it pulls those dollars back through government bonds. In other words, the U.S. prints dollars to buy goods from you, then offers treasury bonds so you can lend those dollars back. It's a never-ending recycling loop. America buys your goods, you earn dollars, and then lend those dollars back to them. They pay a little interest and start the cycle all over again. In the early days, lowering interest rates solved the debt problem. But over time, the world grew wise. Thrift Island realized Squander Island was winning without working. Foreign investors began slowing their purchases of U.S. bonds. Lending dried up. The dollars America spent didn't return. Cutting interest rates no longer worked. So the U.S. had only one path left: expand its balance sheet, print even more money. And now, in 2025, global appetite for U.S. bonds has plummeted. Cutting rates or printing money no longer attracts foreign capital. Enter the new weapon: tariffs. Tariffs force money back into America's hands. It's no longer about trading fairly. It's about demanding tribute. Previously, America fed the global economy. Now, it's draining it, pulling factories, jobs, and capital back to its shores. Squander Island no longer needs labor from Thrift Island. It's bringing production home. And with that, the balance of power begins to shift. But here's the paradox. These aggressive tariffs have caused the dollar to fall hard. With 2025 seeing a flood of U.S. bonds maturing, America must repay its lenders. But what if those lenders no longer want to reinvest? What happens if they want to convert their dollars back to their own currencies? And here's where it gets painful. If you bought U.S. bonds in 2020 when rates were near zero, you might be earning a mere 1 to 2% interest. Now in 2025, your bonds mature. But if the dollar has dropped 10% against your home currency, you just lost more on currency than you earned in interest. You have two options. 1, cut your losses and walk away. 2, reinvest in U.S. bonds, this time locking in a 4% yield and hoping the dollar rebounds. But the reality? You have no real choice. You're forced to reinvest because the alternative is worse. That's the hidden function of tariffs. They trap global capital inside the U.S. economy. It's economic containment. Bonds get bought. The funding crisis is averted. But if too many people accept the loss and exit, it leads to what we warned about in previous videos. America rises from the ashes. But only after a self-inflicted financial wildfire. A new crisis allows them to reset, print again, and restart the machine. Still confused? Go back to our last video for more context. But here's what matters now. Buffett still hasn't bought the dip. In fact, this year, he sold off his remaining bank and financial stocks. Completely. He's not hedging. He's positioning. He's betting on the biggest financial meltdown of our time. Why? Because if the dollar is indeed going to hell, as he has hinted, dropping 10%, 20%, maybe even 30%, then foreign investments in U.S. assets are trapped. If a meltdown happens, no one escapes. You don't just lose on falling stocks or bonds, you lose again on the falling dollar. Assets you thought were safe become prisons. And once fear kicks in, no one buys U.S. assets. The dollar drops further. Markets freeze. Foreign capital stays away. This becomes a war zone for investors. And what about Buffett's own portfolio? Isn't he exposed too? Isn't that a contradiction? Not quite. Though he holds $350 billion, only about 25% of it is in liquid cash. The rest isn't in publicly traded stocks. It's locked into private businesses and legacy holdings like Coca-Cola and American Express. These aren't speculative bets. They're dividend machines. Buffett doesn't need stock price gains. He earns from operations. His real wealth is in productive assets, businesses that generate cash flow even in downturns. And the dollar, even if it plunges, it doesn't ruin him. Think of it like this. If you're a Japanese citizen spending only yen inside Japan, a falling yen doesn't hurt you. Same with Buffett. His cash is stuck in the U.S. He's not converting it to yen or euros. Even when investing in Japan, he borrows in yen. He doesn't convert his dollars. If he tried to convert all $300+ billion into another currency, it would crash the dollar instantly. He's not avoiding dollars, he's trapped in them. But here's the kicker. That trap is his strength. When the dust settles and no one else can buy, Buffett will be the last man standing with cash, access, and leverage. He even said it himself. Within 5 years, he'll reduce his cash from $350 billion to just $50 billion, the minimum needed to operate his companies. The rest? He'll deploy during the greatest fire sale of our era. And the timing? He hinted it might be before Trump's next term ends. So ask yourself, what does Warren Buffett know? That the world is only beginning to realize? Subscribe to Prosperity Magic, leave us a comment, and don't miss the next chapter. Because when the final wave hits, you won't want to be the last to move. And now, let's wrap up this extraordinary insight into Buffett's ultimate strategy with one last, critical piece of the puzzle. According to Buffett himself, what we've seen so far in the U.S. stock market isn't even close to a true crash. These recent fluctuations? Barely an appetizer. A real bear market hasn't arrived yet, and the Oracle of Omaha hasn't even begun to act. Instead, he's pulled the trigger in reverse, dumping all of his bank and financial stocks. Why? Because when the dollar crashes, as he believes it will, banks and financial institutions will suffer the deepest wounds. By 2030, Buffett plans to complete his bottom-feeding strategy. And what will he be buying? U.S. assets. Because that's all he's legally and strategically positioned to acquire. And just like Buffett, the majority of my capital is also in U.S. dollars. The difference is, while Buffett's capital is monumental, so large he must be careful and risk-averse, We smaller investors have more flexibility. He can only park his money in short-term treasuries to mitigate risk. Meanwhile, we've already started allocating into gold, Bitcoin, and the Japanese yen since last year. Why? Because we need a hedge. Something to protect our wealth against the potential collapse of the dollar. As long as those safe haven assets rise faster than the dollar falls, at least we preserve what we've earned. Yet, many people still rush into U.S. stocks the moment they see even a slight recovery, converting all their savings into dollars, hoping for fast gains. Everyone has the right to choose their strategy, and I respect that. But I can confidently say the risk in U.S. equities today comes from more than just stock valuations. It's also tied directly to the currency itself. Let's say you're Japanese. If you invest in Japanese stocks and the market dips, your losses are limited to the equity. But if you invest in U.S. stocks and both the stock market and the dollar drop, you take a double hit. Maybe your investment gains in price, but if the dollar weakens, your return evaporates. Your wealth gets trapped, because converting it back into yen now means accepting a loss. And if the financial slaughter we've been forecasting finally begins, those who jumped in too soon will be the first to fall. For me personally, since late last year, the goal hasn't been profit, it's been protection. Now is not the time to chase gains in unstable markets. The risk of loss outweighs the potential upside. If we profit a little from rebounds, fine. But if we get trapped, we risk losing much more. And if you're confused about any part of this video, I encourage you to go back and watch the previous 2 or 3 episodes. I've said it many times. My videos are connected. Each one builds on the last. Without watching the earlier content, it might seem like I'm only commenting after the fact. But much of what's happening now we've already discussed. I can't re-explain the full context every time. It would drag the content too long and make it less actionable. With everything becoming more chaotic by the day, our time is precious. So we'll stop here for now. I share these insights freely on how to grow wealth, become an entrepreneur, invest smartly, and move closer to financial freedom. If that's a journey you want to take, please subscribe to Prosperity Magic and turn on notifications so you never miss a moment. And if you found any value in today's video, share it generously. Forward it to someone who needs to hear it. I sincerely wish that everyone who hit the like button today reaches financial freedom soon. Even if just 1 or 2 lines from this video helped you think differently or improved your life in some small way, that, to me, is already a win. Thank you for watching. Stay sharp, stay prepared, and stay connected to Prosperity Magic.